So, of course, with any businesses out there, there's always a constant need for us to assess the situation and be aware of the different potential risks that we may have to face. So, this brings us to our next topic, that is climate change and pandemic risks. Discussing this topic in detail, we have Dr. Gunther Kraut, Global Head of Epidemic Risk Solutions, Munich Re. Professor Charlie Donovan, Executive Director, Center for Climate Finance and Investment in the Imperial College Business School. Gautam Mukharya, Chief Risk Officer, HSBC Singapore, and Patricia Chu, Chief Growth Officer, Mana Impact Partners. Our moderator for this session, she is Ngee Lim, Secretary of Singapore Fintech Association and CEO of NH Expansion.
Hello and welcome. I'm Ngee Hua, the moderator today for the topic on climate change and pandemic risk. Under this panel, we discuss investments and risks relating to climate change and COVID-19 pandemic agenda, respectively, and compare how one agenda affects the other. We also talk about how the academia, the financial institutions, and investors, represented by our four esteemed panelists, can work together with the regulators to capture sustainable finance and pandemic investment opportunities and mitigate risks, as well as their respective measurement yardsticks and new approaches arising during the pandemic. Self-introduction here, I do investments in different industries and geographies. I live and work for over 10 years in China, India, Japan, and Australia. I'm a founding member of Far East Organization Venture Capital Arm. I acquired the first ESG project in India for Sembcorp Environmental. I work under private equity fund and REIT of Escort Group, an asset managed accumulated portfolio of 2 billion. Today, I'm the Secretary of Singapore Fintech Association, where I'm also one of the judges for Singapore Fintech Award 2019 and 20. I was also recently recognized as a leading female leader in Asia, the only Singaporean released in the Fintech Times, as an expert specifically in InvestTech. As a founder of NH Expansion, I advise on cross-industry expansion strategies as intermediaries for tech and alternative investments. Let me invite the panelists to do a short introduction of themselves. Can we have Professor Charlie first, followed by Gautam from HSBC, Dr. Gunther from Munich, and Patty.
Hello, everyone. Good afternoon. My name is Charlie Donovan. I'm a professor of practice in the Department of Finance at Imperial College London and executive director of a research center called the Center for Climate Finance and Investment that sits within the business school at Imperial. And I'm a co-founder of a new Singapore Green Finance Center sponsored by the Monetary Authority of Singapore and 9 global banks, of which HSBC is one. So my pleasure to be with you today.
Hi, my name is Gautam Mukharya. I'm the Chief Risk Officer for HSBC, responsible for managing all risk areas across the group operations in Singapore, covering the wholesale and the retail bank, insurance and asset management entities. I've been with HSBC for close to 20 years and have had the opportunity to work in multiple geographies for the bank. Over the years in Singapore, I've been very actively involved with innovation, the fintech ecosystem here and the Fintech Festival. I've been an advisor and mentor to a number of fintechs previously, privileged to be on the demo day judging panel for the Accelerator and also sit on the judging panel for the Fintech Awards to be announced tomorrow. But today I'm going to focus on my other passion, which is around environmental issues, an area I've been working very closely with the industry as well. I was honored to be requested by MAS to chair the working group that co-created the regulatory guidelines on environmental risk management for banks. I currently chair the risk management work stream under the Green Finance Working Group formed by MAS to help develop the roadmap for Singapore to be the leading center in this area. In today's panel, I'll share my views on how I see the space evolving from an opportunity as well as a risk management perspective, talk about some of the best practices from HSBC, and look forward to the discussion with fellow panelists.
Good afternoon. My name is Gunther Kraut. I'm living in Singapore. Originally a mathematician by training, I've studied at LMU Munich and Technical University Munich, followed by a PhD in risk and insurance, where I've already had one research focus on extreme mortality risks, such as pandemics. Now I'm working for Munich Re, one of the leading global reinsurance companies. There I'm heading a unit called Epidemic Risk Solutions. And that is a unit which has a global mandate and across all lines of business, which is somewhat unusual. So meaning we do non-life business interruption just as much as life reinsurance. That is due to the specifics of the risk factor, pandemic risk. In setting up our unit, it is worthwhile noting that we are not a reaction to COVID-19, but we have been started as a business unit in 2017 already. And even before then, I was leading and structuring the first global life pandemic retrocession program for Munich Re, for example, which is one of our tools how we manage that risk factor. In setting up these things, it is a field where we need to have a lot of cooperation with academic partners, with other private sector partners. And while you all probably are familiar with Munich Re as a reinsurance company, you may not be as familiar with Munich Re on the side as making investment products available. And this will be one of the focuses that I talk about today, the asset class pandemic investment.
Hi, everybody. My name is Patty, and I'm the co-founder and chief growth officer of Mana Impact Partners. We're an impact investment and advisory firm based here in Singapore with a focus in ocean health, food and agriculture, and circular and regenerative systems. Really glad to be here today with my fellow panelists.
Thank you, Patty from Mana Impact Partners. Our first question for today is targeted at financial institutions. What is the impact of COVID-19 pandemic on the climate change agenda and vice versa? Do you see opportunities to build back better after the pandemic? Gunther, please.
Sorry.
Gautam, please.
Yeah, Ngee, thanks very much for the question. Let me do this a bit of scene setting here. To my mind, COVID-19 pandemic is a live example of sustainability crisis. Our economy was not ready for the kind of scale like we've just witnessed, the supply chain disruption that we've witnessed. A climate risk obviously has the potential to be much more drastic in its consequences and longevity. The pandemic served as a test case of what may be coming next, and clearly we need to do much more to be ready. It sensitized the world on how vulnerable we all are to the forces of nature and underscores the importance of taking timely and collective actions to mitigate this global challenge. That's why the focus on sustainability has got renewed considerably in 2020. Let me share a few data points on this. As an organization, we see material opportunities to build back better, and we've seen significant increase in activities in sustainable financing market amidst the pandemic. Global social bonds and sustainability bond issuances are up by 400% and 80% respectively year to date as compared to 2019. Green bond issuances have also kept up and crept up in 2020 over 2019. Closer to home, ASEAN green financing market doubled in 2019, and Singapore has the largest share in that, which is over 55%. HSBC recently did a survey covering 1,000 investors and 1,000 issuers around the world. And it was very clear that the commitment by the investors as well as issuers to ESG has increased manifold, with Asia leading the way. Asia is amongst all regions leading in its commitment to environmental and social concerns more than anyone else. 40% of the investors here and roughly 45% of the issuers in Asia affirmed that the COVID-19 pandemic has reinforced their commitments to sustainability and ESG. Asian issuers also has had the most favorable experience with green funding across all regions globally. The Asian region was also most optimistic about the potential of sustainable infrastructure investments, with Singapore specifically being the most enthusiastic among countries, especially in the area of smart city and wastewater infrastructure investments. To summarize, I clearly see an increase in focus on climate change during strategic business and risk discussions across financial institutions that I interact with. This has partly been driven by the regulatory expectation, by the board and the management realizing its growing importance, but equally accelerated by the COVID-19 crisis. We saw different governments doubling up their commitments in this area post-pandemic. MAS has significantly enhanced its effort in this area through its Green Finance Action Plan to support a sustainable recovery for Singapore and to facilitate transition to a sustainable future. As part of this plan, HSBC has been honored to chair an industry-leading green finance working group that is working on a number of key initiatives to take this agenda forward. That includes looking at a green taxonomy for Singapore to help direct financial flows to support sustainable developments in ASEAN. B, looking at an innovative technological solution to collate carbon footprints data for various listed and unlisted companies and making it available to the financial institution, both from a risk management perspective as well as helping in the disclosure requirements. C, pilot schemes to facilitate transactions in priority areas like trade finance and sustainability investments. So lots happening, and the focus has significantly got accelerated this year in this area.
HSBC is busy working with industry players, not only working with industry players and the regulators, but looks like HSBC Singapore has a boom year. Let's hear from Dr. Gunther, his views from Munich Re perspective.
Thank you, Ngee, and thank you, Gautam, for the overview. Maybe let me add a little bit about the risk itself to start with. So if you compare epidemic and pandemic risk, I mean, we all now know from the newspapers there are also correlations between these two risk factors. For example, well-established research exists that there are impact factors from the climate and weather risk side, which also lead to an increasing risk on the pandemic risk side. Take, for example, a higher level of rainfall will lead to more mosquitoes in many parts of the world, hence in the consequence to more malaria cases. So these are consequences. There are also very illustrative, a lot of seasonal diseases, right? Where certain diseases have a higher caseload in either summer or in winter, depending on the vector or the pathogen needing a higher temperature or lower temperature, as we currently see in Europe and the US very, very drastically with COVID-19. Now, also the other way around, there are, say similar factors. So COVID-19 now led to reduced airplane travel, for example, which is in a way the same dimension impacting the risk exposure for climate risk, but obviously also typically very prominent in distributing a disease across the globe. While these individual elements and variables contribute to how risk exposure is, in comparing climate and pandemic risk, maybe the most important similarity is that those are a systemic risk. So there may be local weather events, there may be local and regional epidemic outbreaks, namely Ebola, the SARS and the MERS, but obviously they can turn into the global pandemic, and in that situation diversification breaks down, and that is a challenge. That is why traditional risk management approaches are at the limit or cannot work anymore, and that's also why, for example, for making pandemic risk bearable as a society, you have a lot of discussions across the globe right now how to best involve government as a risk bearer to, if you want to cover all economic losses. Now, nevertheless, we believe it's important that you also have private sector involvement and also private sector market segments, niche market segments. Why so? For different reasons. First of all, whatever we can contribute as an industry, as an insurance, as a finance industry, is definitely beneficial. But also it is very important to have a price tag for a risk factor, because only if you have a price tag, you can incentivize preparedness. If you have a choice between transferring a risk or preparing for a risk, that ultimately contributes to the right behavior and to increase resilience. Now, on pandemic risk in particular, this is again a challenge for the insurability of the risk. So what do we need to do? We need to here really involve many different shoulders to help carry the risk, because the risk can reach a scale like the 1918 pandemic, like COVID-19 now on the business interruption side, on the economic consequences. And that is clearly too large a risk for an individual balance sheet to hold. So we'll talk about how we can help or invite many investors also to participate in carrying this risk.
Professor Charlie, thanks. Thanks, Dr. Gunn. Professor Charlie, I have a question for you. How has you as an ecosystem player been capturing and enabling sustainable finance opportunities for yourself and other players in the economy?
Well, I suppose the first thing is to recognize that as an academic institution, we're a different kind of ecosystem player than HSBC or Munich Re, so not a principal to transactions. So we have a different role, and a lot of that's obviously around education. So we run a dedicated master's on campus in London, but with this new activity in Singapore, we'll increasingly be extending both on campus at Singapore Management University, our partner there, as well as a lot of digital offerings, which is the flavor of the year, in order to try to bridge some of these gaps. And I think that the major gap comes around, the understanding climate, and I think there's a very interesting analogy as both the speakers mentioned about climate change and the pandemic. A lot of differences, but some similarities in the sense that it's very difficult for the human mind to stay ahead of the curve on what happens when you have exponential functions working from the natural world and starting to affect our livelihoods, our economy, and everything that we do. And there's a really important thing with climate change to remember, which is that whatever we're doing today is basically setting the future for 20 to 30 years' time. And that has to do with the lag of greenhouse gases and how they stay in the atmosphere. So even if we were to turn off the taps today, we're going to be living with the consequences of what we did yesterday for the next 20 to 30 years. And so these kinds of insights that come out of academic research are things that we try to apply into the classroom, but increasingly feel a very strong mission that we don't have time for everybody to come through a classroom to do this. And we have to, as an academic institution, get out in the world more and find new ways of delivering that kind of knowledge so that people can, decide for themselves how they want to deal with these things, how they want to prepare themselves, and how they want to create better resilience in their own businesses and in their own family lives, and just top to bottom everything that we do. So a lot of what we do comes down to education. I would say the second thing that we do is around standards and methodologies for analysis. So at some point, we think about finance in a certain way. Why is that? Because of economists from actually half a century ago who did some of the original work on risk and return, portfolio construction, all of these things, and we're still living with the consequences of those ideas. And so it's really important that those kinds of ideas are tested, find acceptance, and then become a sort of a standardized way of thinking about the problem, because we don't have that as of today. And that's, I think, becoming a real barrier for capital markets to dive in the way that they could. And the last way I'll just mention in terms of what we're doing is very much similar to what HSBC is doing, which is to try to help encourage entrepreneurs, and particularly in the fintech system. What we see is the biggest gap right now is a data gap and an information gap, and there's a belief that if that information gap could be closed, capital would be allocated more efficiently, and outcomes would over time become better. And that's a key source of a problem in the market as of today. And I know a lot of young men and women coming through our doors who have great ideas about how to change that situation. And so providing a platform, providing encouragement, providing mentoring, getting them connected with investors, these are the kinds of things that increasingly business schools and academic institutions need to do to accelerate that process of adoption.
Dr. Gunther, you're a mathematician. What do you think?
No, I mean, it's a nice introduction, really, which Charles has given here, because let me focus on the practical implementation of doing some of these topics. So risk transformation is really a key word here for making ultimately the risk more insurable. Why is it not directly insurable? Maybe to make to give some concrete numbers to that. You can see the numbers, for example, from the American Property and Casualty Insurance Association, who have just calculated that if you had all the business interruption losses of COVID-19 insured, the capital base of the whole insurance industry would have been depleted in only a couple of weeks. So this is a risk which is just an order of magnitude too high to make it insurable in a traditional way. You see a lot of comparisons to terrorism risk, where also 9/11 was a very seminal moment for the development of terrorism insurance. But there you were talking about losses of a couple of billions directly caused to the event, and now it's really about trillions of dollars. So there you need to involve many, many more shoulders. Insurance company balance sheets are too small. That's simple. Now, in this process, a reinsurance company like Ngee has a very natural role in the value chain. Because on the one hand side, we can really serve as an aggregator or with the expertise to make the risk insurable, right? Taking it on from the corporates. You need to understand the risk. You need to have your risk models in place to be able to assess the risk, quantify and price it. On that basis, you can write it on to your balance sheet and take it over. Now, to the very small limit that we could hold here on our balance sheet over time, we would like to involve also many primary insurers, right, to really develop the skill set of underwriting expertise, of pricing expertise, but also of distribution of the solutions to the marketplace. Now, in this case, we cannot hold it, so we need to pass it on. We need to turn around and really then enable participation for investors, because the global capital markets are obviously having much deeper pockets than the insurance industry. And I'm talking beyond the traditional ILS markets, right? Really talking about all the balance sheets of the pension funds and so on, and institutional investors. Now, they do not typically have the expertise of underwriting individual business interruption risk of individual companies. So here you really need to have a transformation, and that is the risk transformation I'm talking about. Also, you typically have different regulatory formats. An investor may be able to invest into a bond, maybe into a derivative, but they typically would, for good reasons, not have an insurance license, right? So again, here you need to make it accessible for investors and also maybe convince investors that it is a good risk to participate in. There are two ways of understanding the investment aspect of pandemic risk, because now you will say, well, of course, the pandemic caused a financial crisis, the stock market went down, for sure. So it's not completely uncorrelated as other classes. Nevertheless, take the example of the financial crisis in 2008. So that did not cause a pandemic. So diversification in a large enough investment portfolio is increased. Maybe even more important for investors is a relative value aspect. If you look at a certain risk category, say extreme mortality risk, that has a certain expected loss, but the coupon, the return which is paid for taking that risk, is higher than the return in a credit portfolio, in a comparable credit portfolio. Comparable in the sense that it has a similar expected loss. And fixed income rates and returns have even decreased in most cases now during the pandemic, whereas these returns of pandemic investment actually remain stable. So this is really something where we can believe that is a big important value proposition to facilitate the involvement of more capital, hence more private sector participation in the risk beyond government capacity. There are other aspects. For example, to an insurance product, you can attach risk management services. You can have certain consulting services. You can have certain preparedness services which come alongside the policy. Over time, maybe as the preparedness of the insured risk improves, might even reduce the risk premium, because now it is a better risk which is better prepared to withstand an epidemic or a pandemic outbreak. And these are examples why it is so important to have a market mechanism and a market price tag in place as well. So these are really the two aspects to make it work and to ensure industry participation. So on the one hand side, we need to develop an insurance market, which will take time. On the other side, we need someone like Ngee in the middle to be the transformator to then enable a bigger, call it a pandemic investment market, to also develop much beyond the scale it is developed today.
Patty, please. Patty, can you answer this question as well?
Yeah, sure. I think mine will be a little bit different as well, kind of perspective. So we set up our company with social and environmental impact front and center, and really seeing ourselves as the catalyzers or enablers in getting more players, specifically, I guess, in our mind, more high net worth individuals and investors to be involved in investing with an impact lens. And I do, I share the same views as Gautam shared earlier on. I think that there's definitely a lot of interest, increasing interest in Asia. Having said that, I think that the ecosystem in general for, I guess, impact investment specifically, is still quite nascent in Asia. And so therefore, we do see a strong need and role in sort of building up that capacity. So for us, we work with both, earlier stage companies, as well as investors, and being a little bit of a bridge in helping them connect the right sort of profile, risk profile, and interest and impact targets to each other. We have seen a lot, compared from when we first started, a lot more interest specifically in the environment as well. More recently, we have seen also more other funds and VCs that also are looking more interested in getting, I guess, also investing with an impact lens. So we're supporting a lot more on the strategy side, on creating a well-defined impact measurement metrics and management plan. So that's sort of the role that we see or we play in the ecosystem.
How do you integrate ESG into its risk management policies and framework and embed into its governance? Can I have Professor Charlie to comment? Professor Charlie, please.
Yes, sorry, just having my with the mute, the pandemic error that we all suffer from. So I think that the kind of the way that we think about it, and I think that this is about the evolution of ESG. Because now we're moving it beyond kind of the umbrella term, and we're starting to get a lot more granularity around what are these price risk factors which are moving markets, and that's I think that's very exciting, because we've been in a period of time where during this year there has been a lot of speculation about the outperformance of funds and listed equities and fixed income with an ESG flavor. But in my own mind, it's not entirely clear what people think that they're talking about when they say, what is that attribution? And I think in finance, we tend to think that flavors of the month don't tend to stick around very long. They tend to melt like ice cream in the summertime. And so the question becomes, are there enduring risk factors underneath the ESG umbrella? Clearly, climate is one of them. I'm personally convinced of that. And there is a lot of increasing academic research ongoing to identify within climate, what are those risk factors? So even climate as a subset of ESG is not itself a very stable risk factor, because it's made up of different components, not only how climate change is affecting companies, but how companies are affecting the climate, so physical risks and transition risks. So it is. It's getting more complex, which I think is a good sign, because if it's getting more complex, it must mean that we're getting beyond the simple narratives and moving into really what is the domain of quantitative analysis that can help us reveal what these things are, what's their size, what's their persistence, all of the things that we as financial analysts all enjoy doing. So it's an exciting kind of next step in this, and this ESG integration is really moving, I believe, into its natural conclusion, which is speaking about specific things like climate change, like water, as financial risks, and working on the specific types of financial securities, whether that's fixed income, project loans, listed equities, private equity, whatever it is, and trying to make that process of integration. And that's a lot of work. That's a lot of work, but I think that people are finding that if they can get their head around that, and they can do that ahead of their competitors, that there's the potential for outperformance. And that's obviously what motivates people in financial markets to do that kind of work.
There seems to be a lot of work. How far are we at this, Professor Charlie?
Sorry, I missed your. How far along are we? Is that what you said?
Yeah. Yes. That's what I'm asking.
Well, that's interesting. That's a very interesting question. I think that clearly there's a dynamic globally in which, Europe has had a certain amount of a head start. There was probably a higher level of awareness about, let's not even say environmental issues, but planetary boundaries, and as a way of framing. At some point, you start to approach a limit, and when you go over that limit, there's going to be some kind of response, and that's what you're looking for. So the first stage has been awareness building, and I think that awareness building, the fact that we're having this conversation in a Singapore conference is fabulous. This is clearly, the awareness is going to change very quickly in the US. So I think the awareness process has become a global phenomenon, and there is something about the pandemic that has revealed that there are other just inescapable truths about our interaction with the natural world, and these things can come back to bite you. If you go to the question about how far along are we on risk integration, I think that's a tougher process, and clearly the commercial banking industry is I would say right in the fight at the moment, and so stress tests in various jurisdictions have really amazingly changed the level of sophistication about this conversation within the commercial banking sector. Insurance has been and folks like Munich Re have been aware of this for quite a while, and a lot of approaches are looking to learn from insurance. And I think the next frontier is around asset management, and which a little bit, gets to the question of how do people want to manage their money, and how do they want to, on the equity side, take advantage of what will be the opportunities, and not just position against the risks. And that's tricky, and that's going to be something that won't be solved immediately, and it'll probably evolve, over a long period of time. So I think it's fascinating, because it means that the investment, we're talking about something that will probably be a secular trend over the next few decades. And hopefully that, if people believe that, and they see that, and they see the evidence for that, then it increases the likelihood that they want to invest the time and effort to really get their heads around it.
Gautam, we can't miss you to answer these questions from the bank's perspective. Can you comment on that? And also, on top of the questions on how do you integrate ESG into risk management and framework, talk about how much more we have to go before we reach the mature stage. Yeah.
Thanks very much for that question. First of all, I completely agree with Professor Charlie. I think it's a journey which is evolving quite rapidly in terms of integration of environmental risk or the wider climate risk into the risk management in commercial institution. Let me start off by articulating what, from an organization perspective, what is HSBC's ambition in this space, and then get into specifics on how we've integrated this into our risk management framework, and maybe cite a couple of examples of areas that we've been focusing on, to achieve that level of integration. HSBC as an organization a couple of months back announced a very ambitious plan to become a leading bank for transition to net zero. In addition to becoming a net zero bank ourselves, i.e. net zero in our operations and supply chain by 2030, and net zero, more importantly, with respect to the carbon emission of our portfolio of customers by 2050 or sooner, we've also decided to intensify our support for customers by providing up to $1 trillion of financing and investments by 2030 to enable the transition to low carbon emissions. We've also committed to unlocking new climate solutions by investing in climate innovation ventures and building one of the world's largest natural capital manager in a joint venture with Pollination, amongst others. All this is not practical or possible by proper integration within our risk management framework. And while we've been incorporating climate risk into our risk management framework and our processes for many, many years, this approach has continuously evolved over the period of time. The bank's risk appetite statement has been including a qualitative risk appetite, articulating our approach to climate risk for the period of time now. And this is in the process of further getting refined in 2021. Our board and risk management governance meeting at various levels in the organization, be it group, regional, and country, require the presentation of risk profile that includes all key risk and climate risk, invariably figures amongst those, if not on top of those, that risk profile for the entities. We also have a climate risk forum and an ESG steering committee at a group level to provide executive oversight of the commitments around climate that I mentioned. Specifically, let me call out two examples. The first one is around the transition risk management, which is one of the critical pieces, in terms of financial risk around climate. When we look at transition risk, we kind of look at it from three perspectives: understanding our exposure to transition risk, understanding how our clients are managing transition risk, and measuring progress in reducing carbon emissions. In 2018, we identified 6 higher risk transition sectors that we wanted to focus on. To track the progress of our client in reducing the carbon emissions, we then piloted a scheme to calculate the weighted carbon intensity ratio for close to 1,000 customers in these high-risk transition sectors. And based on the data that we sourced from CDP, we then calculated the carbon intensity emission per $1 million of revenue for each of those clients. Then we risk weighted this with with our exposure to these clients, and then which in turn helped us to form a risk-based view on these sectors, which we've been disclosing as part of our governance. We also developed a very detailed transition risk questionnaire to identify clients who need to rapidly adapt to climate risk and to spot business opportunities. Now the industry in Singapore is actually looking to agree to a common set of transition risk questionnaires across all banks, thus enabling clients are consistently asked the same questions. Such a questionnaire was debated and agreed while we drafted the regulatory guidelines for Singapore, and is now supposed to be embedded as part of the capacity building initiatives which are currently underway in Singapore. Let me talk also a bit about the asset management business, which, as Professor Charlie mentioned, needs a bit of evolution. But in HSBC, ESG considerations are an integral part of our security analysis as much as financial considerations across all asset classes. We are signatory to various investor stewardship codes and recognized as a leader in ESG integration in this area. Almost 90% of our global AUM incorporates ESG integration, with close to $6 billion AUM in dedicated sustainability investments. When we look at investments in companies, we prioritize companies that operate in principles of good governance and environmental sustainability. Each investment is assigned an ESG rating of low, medium, and high, and critical sustainability teams are evolved and reviewed by specialists. There are several case studies in our portfolio where our engagement approach, for example, being a member of the client's advisory committee, has helped the client to announce carbon reduction initiative in phases, improve disclosures, and governances. Those are some of the practical examples on how we're evolving this journey and embedding this into our day-to-day risk management.
We have talked at length about agendas, about framework, risk management policies, governance. Let's have something real. What are the real investments or policies you have discovered in your area of work? This question is attention to all the panelists. Can we have Professor Charlie to speak on this first? Professor Charlie, please.
I'll say quickly because I want to give. I'm fascinated with what others will say on this point. But I think my own area, having I spent a bunch of my career working for BP and saw kind of firsthand the tension associated with the shift from oil and gas into renewable power. And for me, we did some work with the International Energy Agency last year to look at how has renewable power performed on listed stock markets around the world? Because there's still a sneaking suspicion, I think, amongst a lot of people that well, after this all kind of blows over, it's really going to be oil and gas that's kind of the most profitable. And over the past 10 years, we found actually the opposite, which is that this trend that we've seen very pronounced in 2020 in terms of a huge takeoff in the share prices of renewable power companies and a real decline amongst the energy majors. This is a storm that's been brewing for 10 years. And then in the study that we did with the IEA, we found that both on a risk-adjusted basis and on an absolute basis, a portfolio of renewable power companies outperformed their fossil fuel cousins. So this is interesting to me because as a personal investor, I know that I have not done well in some parts of the renewable value chain. Certainly, the solar manufacturing sector now is hot as you can imagine, but it was for the majority of the last decade was a really terrible way to invest. So there are things there. This is all symptomatic for me of an industry which is growing fast, starting to create some value destruction within the traditional industry, but is still finding its way in terms of where is the economic rent capture. And that's not, is it upstream? Is it downstream? Is it midstream? I mean, those are the kind of all the analogies that we would use in oil and gas. And those are analogies we're going to have to start to employ for this new industry. And it has some very unique characteristics. And I continue, even though I've spent 20 years working in that space, I continue to be fascinated by how these inherent differences between an electric power future and a hydrocarbons history, how that's going to create some real discontinuities in terms of investment opportunity. And that's where I'm spending my time. I don't have any stock picks to share with you, but that's really that tension between those two industries within energy is really, I think, fascinating and something to really pay attention to.
Gautam?
Yep. I think the opportunities come with working closely with the clients to try and understand what their needs are. And as we understand the clients, it itself presents us with an opportunity. So the focus for us in this area has always been to work with the clients to find the right pathway for each of our clients, taking into consideration their unique circumstances, and to help them reduce their emission, which results in multiple opportunities for us as a bank. Let me cite two examples, again, closer to home in Singapore. We've been very engaging with the SMEs and the wider industry to identify solutions to drive green financing. We were the first bank in Singapore to launch a green product tailored for the SMEs. It's very easy to talk about the big end of the town, but it's equally important to make green financing accessible to small players in the ecosystem. Our green loan framework in Singapore provides a simplified framework that reduces time, complexity, and costs typically associated with green financing for SMEs. In fact, we are delighted that MAS recently announced the Green and Sustainability Linked Loan Grant Schemes, the first of its kind globally, which we believe will further accelerate the take-up of sustainability-linked loans, especially for the SMEs, which we've been trying to drive in the local market. Maybe the other example that I could share is around green deposits for corporate customers, including SMEs. The green deposits are an easy way for corporates of all sizes to support environmentally beneficial projects. The monies, in turn, is then used by HSBC to invest in a portfolio of qualified green assets, which are aligned with relevant international standards. Clients receive quarterly report with their portfolio information regarding the end use of funds. And this is a product that we launched in the local market here and very successfully so.
Dr. Gunther?
Looking at investment products available, I guess there are three categories of products, following largely what the insurance markets made available. So there's one investment class, call it following the extreme mortality stop loss risk profile, which is a transaction typically between a primary insurer and a reinsurer. So that you could consider as an investment grade expected loss risk profile, paying slightly higher than a similar credit portfolio. You have also public sector products or in public-private partnership, often focusing on the containment of outbreaks or the financing of containment of outbreaks. That is often done also with institutions like the World Bank's Pandemic Emergency Facility, which also paid out for COVID-19, or African risk capacity, right? So these products are available. A company like Munich Re would typically be involved as a structure and placement agent also to make it available. Now, the third and maybe most interesting category is for the originating from the non-damage business interruption insurance, so non-life insurance. Take examples from industry sectors. So that could be loss of revenue for hotels, that could be delay in startup for construction projects or infrastructure projects, covers for retail, fixed costs for manufacturing. All these then passed on to the investor to make accessible as an investment product, profiting from the insurance company's underwriting. Compared to the extreme mortality stop loss profile, this is paying higher than investment grade, but has a higher expected loss. I mean, if you look at Asia, we had 3 coronavirus outbreaks in the last 20 years. So if you are a hotel here, clearly you are exposed at a different level. Worthwhile noting, maybe, there are players in the value chain, like Munich, who are on both sides. There are players who, I guess, are purely looking at the investment side. But also for a bank like HSBC, right, you have different aspects. You see the risk in your own portfolio. So you could also say for certain key areas and key projects in exposed areas, to the degree that insurance capacity is available, you require for the financing that this cover is in place. Now, simultaneously, you're also obviously very active in the investment space and could also make the distribution, contribute to the distribution of such classes. And this is really how the market can develop. And also, I mean, talking about that expected loss, right, there are also solutions to address the affordability of such products. So you could also think about hybrid products, combining both insurance layer and on top of that, on top of the same underwriting, a contingent lending layer. Also, that is a situation. Right now, we don't have a developed market. A lot of banks do suffer from loans being extended. So at least you could make these things also more transparent and quantifiable in kind of addressing it and earn the option premium over time. So you have direct investments, and I guess that's the first stage. But over time, hopefully, you see more and more further classes developing on the back of the immediate product.
Patty, please. Patty?
Yeah, thanks, Nihua. So I think, for us, climate change is, again, front and center. So just taking into consideration that we need to, draw down 50 plus gigatons of carbon in order to limit the temperature increase to 2 degrees Celsius. We look at what are the, key industries that can help draw down carbon. So one of the biggest industries is the food and agricultural sector, contributes about 30% of the greenhouse gas emissions, which is why, and also because at this region, a big part of the economy is based on agriculture. So that's another area that we look at and we see that there's potential. So very boring stuff, I think, the very traditional food and agriculture, but doing it more regeneratively as well. So with less chemicals, less pesticides, and more healthy for the people as well. The ocean is another space. 70% of our planet is covered by oceans, and the oceans play an enormous part of regulating our temperature, capturing carbon dioxide. So we see that as another potential area of great investment opportunities. And I think, we are in a Fintech, at a festival event. There's definitely a lot of, and also Dr. Charlie, you mentioned, I think there's been a lot of, investments made in the tech side of things, which is extremely important. But I think that one thing that we investors don't talk enough about is about nature-based climate solutions. Mother Nature is actually extremely smart, and so we forget that there are a lot of ways. I mean, nature plays an enormous part of drawing down carbon, and there hasn't been enough emphasis there. Interestingly, DBS and Temasek actually just launched a report yesterday on a whole 150 pages on nature-based climate solutions, and specifically the potential in Southeast Asia, given the significant amount of natural capital in this region, as well as the fact that the region holds the highest density of carbon prospecting. There are already large institutions like Gautam mentioned, HSBC's partnership with Pollination, looking at natural capital, Thilia. So this is an area that I think that not only myself, but many others are seeing as major opportunities.
That's such an important area. I would love to underscore it, because if you think about how we think about the world and how we think about the economy, we've never before considered natural capital to be an input. We've considered financial capital and we've considered labor, and every economic model has those two starting points. And as you get into the further, as these pressures build, as we've hit limits and the pressures are building in the oceans, in the land, in the atmosphere, then you start to see natural capital as maybe the biggest asset class in the world, and one that is basically beyond the point of the responsibility of the private sector. But now governments, in trying to respond to these pressures, realize they can't do it alone, and are in a fairly messy way trying to share that responsibility with the private sector. And I think in one moment it creates this awareness that this could be the biggest investment opportunity ever if we find the way to create market frameworks that allow the private sector to be a force for recovery, a force for healing, a force for finding a way out of a lot of these problems that we have. And this is, I just wanted to mention that, because it's natural capital for me is not just some subset. It is really the overarching kind of way to think about what these new opportunities are going to be, and they extend in a number of ways. But it's going to take governments to find a way to extend property rights in a very simple way to the private sector, in a way that would allow them to manage those things appropriately, but also take some fair rate of return from providing that service. And that's something we all need to think about, and it really interacts with the policy angle, because there are very few countries in the world that have those kind of frameworks in place as of today. But if we could get them in place, I think it's just amazing what could be done.
Yeah, exactly. Like you said, I think that our current economic system is really based on, economic theories, developed, decades ago, and they don't really account for the true cost, right?
Yeah, indeed. So that comes to our next question on government. How do we work closely with the governments and regulators to abate environmental risks across the financial institutions? So can I have Professor Charlie, you speak at length, just to end off our panel discussions, bite-size, what are the ways academia can work with the governments to abate environmental risks across financial institutions?
Yeah, it's a shame that you saved your toughest questions for last. That's really that puts me in a difficult position, because my own journey in my career has started with government regulation. So I worked for the U.S. Environmental Protection Agency, which is where I first got turned on to all of these things in the late 90s. And I'm not sure that we have, for all the innovation that we see in the economy, I'm not sure we've given governments, certainly not in the U.S., perhaps maybe more in Singapore than in other jurisdictions, but we've not given governments the space to innovate nearly as much, and for regulation to try to innovate in the way that we need it to. So in the UK, where I'm probably most familiar now, there have been, the FCA, which is the financial regulator, has made explicit attempts towards creating what they call a sandbox, which is regulations which are sort of temporary in the sense they want to see if it works, and they're not going to say this is forever. And that kind of experimentation has been very helpful, and people have learned a lot, and there's been a lot of positive outcomes from that. So we've got to find these sandboxes, and we've got to find a way in which, ultimately, as companies, as academics, as voters, as taxpayers, we start to give governments back a little bit of breathing room to try to find solutions that are not obvious, and that's a challenge, but it's something that needs some consent, and that's consent that stretches across multiple parts of society.
Gautam, what do you think?
Yeah, I think the collaboration is moving in the right direction. It's not perfect, but it's evolved and it's evolving. I can see that in the context of Singapore, again, being a bit more specific, 2 examples. When MAS decided to draft the regulation for the industry, they actually decided to co-create it with the industry. They formed a industry working group, which I thought was quite unique, and asked the industry to draft what the regulations would look like, for their own standards. The other area around this to kind of articulate is that the regulations which were published yesterday, and some of you may have seen this, it covers the environmental risk as a whole, beyond climate risk, looking at pollutions, loss of biodiversity, change in land use, all very relevant, in the context of the discussion on natural capital that we had. The ambition setting and the goal setting was upfront quite ambitious, knowing fully well that some of these areas will take time to develop. The other area where industry and the regulators are working very collaboratively is around capacity building, and to ensure that the understanding across the wider industry, including the smaller and local firms, investment companies that we talked about, it's more well understood rather than being restricted to only the big ones. As part of the working group that I mentioned previously, we are actually now in advanced stages of drafting a comprehensive industry handbook to share best practices around governance, risk management, scenario analysis, and also planning to organize workshops by the practitioners, developing online tools, all this in close coordination with the regulators. So I think it's improving, it's moving in the right direction.
Dr. Gunther, what do you think?
Now, I guess there are 2 aspects of it. I mean, the one thing, as much as this is a very seminal point in time for the development of the pandemic investment market, right? It needs to be recognized that right now we still have a lot of market education, which is necessary. And that is something where we are, for example, very happy to also contribute and work in collaboration with MAS in setting up projects such as the pandemic work streams within the Global Asia Insurance Partnership, right? So Singapore has really recognized that they want to be a hub and a center of expertise for pandemic investment and pandemic risk transfer solutions. So now, while the education is there, obviously it is also important that we get it over to the transaction, right? I mean, what better way of education of a marketplace by doing transactions and by doing the spillover of knowledge as more and more companies join and participate in these transactions. So that is something where also here in Singapore, it's a very good marketplace for that, because what we see here in our daily conversations with clients and investors, you have a very close proximity of very important relevant stakeholders, and that we can certainly make use here in Singapore to ultimately then roll it out over the regions, roll it out in different geographies of the world, and hopefully ultimately develop this asset class to make societies and economies a bit more resilient against pandemic risk in the future.
Can we have 1 or 2 Patty, can we have 1 to 2 quick points from you before we wrap up the discussion? Patty, please. Patty, are you there, Patty? Patty, are you there?
Patty may have dropped off, I think.
Hi, so
Okay,
sorry. Patty is not with us right now.
yes.
I believe there's some problems with connection.
Okay, is that okay? Then we just continue on to wrap up then. And with that, we reached the end of the panel discussions on climate change and pandemic risk. Clearly, pandemic is a live example of sustainability crisis. Seasonal weather have implications on many infectious diseases. The silver lining is opportunities in building back better during and after the pandemic. For one, there's heightened Asian investors and issuers' interest during the pandemic, such as HSBC Green Loan for SMEs, MAS Sustainability-Linked Loan Grant Scheme, Asset Class Pandemic Investments, and business interruptions, and investment-grade extreme mortality stop loss from the insurer viewpoint. Food and agriculture, ocean and blue economy, and impact investments involving circular models. With opportunities and risks necessitates development of methodology, standards, asset pricing by type of securities, integrating climate and energy emission models into financial analysis, encouraging fintech entrepreneurship related to climate risk assessment opportunity, granular evaluation of risk transmission channels. Qualitative narrative is as important as quantitative approaches. We are witnessing risk transformation to enable participation of many different players to help carrying the risk and thus making the risk more insurable. And the provision of added risk management service in combination with provisions of insurance policies and new financing approaches for systematic risk and in particular pandemic risk. Transition risk management comes into play involving carbon intensity ratio of portfolio, transition risk questionnaire. At regulatory level, Singapore's efforts are namely Green Finance Action Plan by working industries to identify solutions, data-related initiative, pilot schemes to facilitate activities, set up of Singapore Green Finance Centre with Imperial College to promote tertiary educations, MAS environmental risk regulations, capacity building, and sharing best practices in the areas of governance. Thank you, audience, for tuning in and the panelists for joining us this afternoon. Goodbye